Welcome to the Property Funder podcast. I'm your host, Michael Dean. I've been lucky to sit down with some brilliant minds from the industry on this podcast. This week, we're looking back at some of the most memorable moments from recent episodes, brimming with property and finance expertise. Let's jump in. What are your predictions for 2025? I mean, we had a fairly negative budget from a real estate standpoint, I guess, and the business standpoint. But what are your predictions for 2025? What are the themes that you're expecting to see, and how are you planning to capitalise on them at GRE?
I think what I'm hoping for is for there to be some stability within interest rates, because I think at the moment there's a lot of people that are thinking, there might be some more, downward movement, which will help us. So let's not do that. Let's not kickstart that project. So let's not do that. So I'm hoping for that. I think there will be much more activity next year. I think there has been some confidence instilled in the market, particularly in the latter half. Albeit I appreciate there was a slightly negative budget. I do think from our perspective, we're seeing an uptick in activity, particularly on the acquisitions. So for the last few years, in our space has been, endless refinances, and every inquiry that's through the door is for a refinance. We're seeing many more people that are looking to acquire, and looking to reposition assets, which I think is really, really positive. So we are looking to capitalize it on by way of just kind of writing more business. We've obviously bolstered the team. We've taken on 2 kind of execution operations people to really harness what we're doing there.
Yeah. Where do you see the headcount at GRE by the end of next year? Are you sort of looking to double the size of the team, or are you looking at, or just be a bit more gradual and adding people as and when they're the right fit?
So we've hired a graduate who's going to be joining us in January. I don't think the team will get that much bigger in terms of headcount. We've actually just gone through a process where we've been working with an AI consultant who has basically come into the business and looked at all of our processes across the board and gone, what can we improve there? Where can we make efficiencies there? And actually, the work that he's done has been mind-blowing for us as a business, which will enable us to not necessarily increase our headcount, but the headcount that we've got will be much more efficient. We'll be able to actually really work on things that are value add for us as a business, as opposed to a lot of us spending time doing things that just aren't value add. So we're really looking forward to going into 2025 with all of those AI implementations. Right.
Yeah. So your GPT-4 subscription is well and truly active, I guess.
Yeah.
Can you give, without giving away the secret sauce, the GRE secret sauce, can you give a couple of examples of how you're using AI in the business and taking advantage of that to make yourselves more efficient?
Yeah. So two very simple things. So any inquiry that comes into the business, and as you know, inquiries come through various means, whether it's a phone call, an email. We log all those inquiries because I think it's really useful for our investors. It's really useful for our own internal understanding. The way we log those inquiries was and currently is an Excel spreadsheet, which is keyed in manually by myself or other members of the team. That's going to be basically done via an AI bot.
Okay.
Who'll basically take the information from the email or the phone call and basically put that into a system, which is really useful. And then the other thing is the writing of credit papers. That takes an inordinately long time, and actually the time that's spent doing that could be spent actually really understanding the deal, running the analysis, and really getting underneath the numbers. So they're two of the things that
two of many, I guess.
Two of many.
Yeah.
But yeah, he's the guy that worked with us has been incredible.
Yeah, well, I mean, those of you who've been watching and viewing will know that we've been on our own tech journey, and we hired 3 tech people within Avonmore. So, and one of the things that we're now, one of the things that we're working on as well is, we're working on a variety of things, but we're effectively trying to create a full end-to-end semi-automated lending platform. We're sort of probably 6 months out of 18 months or 15 months along the journey. So probably 9 to 12 months to go before we're kind of there. But it's fascinating to sort of hear that and see that the power of AI and GPTs, the GPTs, or if you're using Claude or Gemini or whatever, and it's only just getting more powerful. And so the stuff that the stuff that we were able to do a year ago relative to what it can do now, the processing capability is amazing. I mean, if you've ever shoved a valuation report through ChatGPT, it's really fascinating to see what it takes out of that, for example. And I guess that the thing that always makes me laugh, and obviously I know you like your LinkedIn as well as I do, it's when I see LinkedIn posts which are so obviously created using ChatGPT. I'm sure everyone knows this now, but if there's an emoji at the end of every sentence, it's probably been written by ChatGPT.
Yeah.
And I don't know why they haven't updated the algorithm to be like, stop doing that. This is so obviously written by AI. When you're looking at these, I appreciate you'll have had a good amount of experience from your days in Octopus in the commercial team, but when you're looking at this sort of broad cross section of sectors, how do you get comfortable with the security? Because you can't every time you get an inquiry, you can't be like, call me when there's a valuation and I'll tell you what I think of it, right? You're going to have to be able to have a view on something when it first comes in. So how do you develop the knowledge and the skills to have that breadth of experience and understanding to be able to give people a view straight off the bat, rather than having to wait for a formal report that could come 4 to 6 weeks later and is going to cost 10 plus grand to a client to get it done?
Yeah, I mean, it's certainly a skill. I think one of the things that we're really good at as a business is actually leaning on our network. So between the people that sit within GRE Finance, there's a network of variety of agents, valuers that we can all lean on for some initial advice. We obviously see a lot of deal flow and inquiry flow anyway as a business, and from that we generate kind of a view just based on what we see. But no, it's not easy, and it's not easy, as you say, doing so many different types of things. But we try, and as a business, we always try and have a discussion between us, and quite quickly we'll get, we get to a conclusion. But no, it can be a challenge, but you just have to be quite disciplined with your time, and not talk over and over and over things, to the nth degree, but actually make a quick decision fast. And that's something as a business we really try and kind of stick to, because otherwise, like you say, we could spend hours and hours and hours talking about things that actually we're never going to get comfortable with. But just having the discipline to be like that. It's all about discipline.
Yeah. I mean, how many of you are there out now at GRE?
So there is 6 of us.
6 in total. Okay.
Yeah. So the 2 founders, myself and another person working in origination, and then we've got 2 people working on kind of operations, execution.
So, I mean, having been in that position, way back when, I think the big, as particularly in the early days of Avamore, especially because we were lending our family money, we were lending, and we had co-investors who were also experienced commercial property people as well. We had that sort of flexibility to do anything we wanted to, actually. And then in the end, we barely ever did anything that was a bit fruity or interesting. But I think but the number of times in the early days we sort of go down a rabbit hole and talk something over endlessly, and then in the end the answer would all still end up being no. We could never really quite get, or the offer that we made was so ridiculously uncommercial, I think we might have burnt a relationship with the broker. How do you prevent yourself from going down that rabbit hole? How do you who is it that makes the decision, right, okay, we need to stop this discussion, we're not going to get there, let's move on? Who does that? How do you stop yourself from kind of just constantly going down that rabbit hole? I
think the thing that stops us is that we're all quite busy.
Yeah.
So we always have like a natural end to a conversation, because one of us will have a meeting or another person will have a meeting. So that's kind of the reason, that's kind of what stops it. But you're so right. You're so right. One of the other things that I do actually, and I'm quite religious on, is I'm always asking the broker or the borrower what other terms they may have, or who else have they gone to. Obviously, as being the owner of a lending business, the market is so crowded and there are so many players, and actually there'll be some deals that there's no point us even kind of entertaining a conversation on, because they may have got terms from, or getting terms, or it may be a deal where there's loads of other people there to do it, and actually they might be they may be better suited to do it. And actually I think you have to, in the lending business, you have to just in some sense, you have to know your place and know actually where you're going to win, and where actually it's better for you to say, look, not one for us.
Yeah.
And I think that's really important, but that does take discipline.
Yeah.
Particularly when you're in a business that wants to grow. you want to be all things to all people, and actually sometimes you have to go, look, it's not one for us.
Yeah.
People respect you more, I think, as well for that.
Yeah, I think that one of the things that we really focus on and we really reflect on is that if we're not sure we can get to yes on a deal, we have any doubts, we'll be like, look, this isn't, we're not sure we're going to get there, so we don't think this is going to be productive to the long-term relationship, particularly with a broker or someone who could be a repeat customer. So we just go, look, I think maybe you should go elsewhere. And I think sometimes you win more by being clear, because I bore people to death with saying this, and I've probably said it on the podcast enough times. We don't sell financial services, we sell trust. Like broker, particularly a business like us, you probably do a little bit more direct with clients, but particularly for us with brokers, people are putting their potentially a 20-year relationship with a client at risk. And if we do them dirty, that broker has potentially lost a long-term revenue stream. So we have to give them that sense of trust that we're going to perform, and then we've got to perform. And if we're not performing, then we're blowing up that trust. So I think where you guys' mindset is spot on. I just want to highlight that actually what I really like that I really like the angle that you're taking as well from a product set perspective, because I think if you're doing things like open storage, that's becoming an increasingly interesting space from an investment perspective. Some of the rents on open storage now are getting quite, because shed rents are really high. But I think 99% of the specialist finance markets can be like, no, well, a funding line doesn't allow us to do that, so we can't do it. So I think you've got a really nice, that as one example is a really nice niche that you can operate within. So yeah, I've got a lot of time for that. But what's the weirdest inquiry you've ever had, and how did you either at GRE or before, and how did you approach that?
I've had quite a few inquiries for cemeteries over the years.
Okay, go on.
I mean, the approach with that is just a quick kill. But I've had quite a few inquiries for cemeteries. I mean, I don't know what you can do with a cemetery. Like, I don't know, but kill those.
Okay.
Other weird things?
And what about fruity or colourful characters that have come to you?
Lots.
Okay,
you get a lot in our space.
What can you say? What can you say?
Oh, gosh. Just people that have a lot of bad press about them. Also, the one thing I think you do realise in this industry is if you have money, people get quite jealous of you, and there's a lot of bad press about people that's probably unwarranted just because they've been very successful.
Yeah.
And a lot of people don't like very successful people, and very successful people often attract the opinions, negative opinions, even if they're not warranted. And I think that's one thing that I've learned. Doing this.
Have you been on the receiving end of some criticism or a bit of hate now that you've got a little bit of success, or you've tasted a bit of success, or you've been immune to it, thankfully?
I'm immune to it till now.
Till now, okay.
Yeah, I hope that stays that way.
Okay.
Don't deal well with mean people, so hopefully it stays that way.
Yeah. The DMs are locked, and keep the mentions. Don't look at your mentions. No, that's interesting. The cemetery thing's interesting. Actually, I've completely apropos nothing. I ended up having a dinner with a very long-standing friend of mine. He's a very successful, wealthy. He's a farmer, but he's more than a farmer. And when the subject of cemeteries came up, and actually that there's there's actually a lot of money in cemeteries now, because of course you can sell the plots. You can sell the plots in advance. Yeah. So that's in, but so again, but you can't do everything, right? And that's a difficulty, right? That you experience. Would you look at paddle courts? Would you?
Yes.
Yeah. I had no idea. Like, I mean, I've played paddle. I like it. I'm played proper tennis as well. It's probably more my thing. But I had no idea how much money there is in paddle now. It's insane.
Yeah.
So have you financed any paddles facilities yet?
We haven't financed any paddle courts to date, but there's still time. Maybe 2025 we'll bring some paddle court financing to our desks. But it's just an income stream. The other thing with paddle courts is, I don't know if you've tried to get a space on a court. Really difficult. In London, super difficult to get a space on a court. So yeah.
So I was I had a meeting with a broker. He's a Spanish guy, and his office is based out sort of Leytonstone sort of way. And I was wearing, I think I had my local tennis club gilet on or something like that. As our viewers and listeners know, I love a gilet. And he said, "Oh, you like tennis?" "Oh, I play paddle." I said, "Okay, cool." He said, I play paddle in this place in Ilford." I said, "All right, yeah." I said, "Oh, it's really noisy." He said, "Yeah, well, they've got 17 paddle courts in this facility in Ilford. It's in a big shed, and it's open until 1 a.m. And he said it's booked all day, right up until 1 a.m. Every single court's booked. It's insane. I don't know if it's like a temporary thing or it's like whether it's going to sort of die off eventually. But the appetite for paddle at the moment is enormous. So yeah, like okay, what would you say the split is between, I suppose, introducer-led business and direct business at the moment that you have?
The numbers last year it was roughly about 35% introducer-led business. I think that probably number was, in a good year, maybe would be closer to 50-50. But I think, a lot of professionals have kind of spent the last couple of years in our sector that's tough, dealing with other things, being busy, talking about, IFAs, whether it be stocks and shares, whatever, and not having time to kind of do that cross-sell or focus on what that might be. But I think 60-40 roughly is a nice number, 60% direct to consumer. It's really nice dealing with professionals sometimes. You'll have seen it, probably feel like it's the brokers that are slowing it down, but, just having documents on hand, having everyone, what's this? Do you have this? Having all of that there coming across to you when you need it as a kind of middleman, I know it's another middleman, but is a really enjoyable way to do business. And I think you can form more business and a longer lasting relationship. How the standard property investor might buy, or someone, let's say, who's not a full-time property landlord, as in they have another job, someone who is, let's say, a lawyer, might have 3 buy-to-let properties in their own house. So you're going to be dealing with, a mortgage every 2 to 5 years, a remortgage every 2 to 5 years, and maybe a purchase every 2 to 5 years. That's not going to, you can't build a business off the back of that.
You need a lot of them to build any business with scale. Yeah.
Yeah. But you get the scale through that middleman of that introducer.
Yeah. I mean, I suppose I see the parallels between us and, for ourselves as well, which is that we do deals directly with developers, but if you think about a bit like you said, a developer is going to be doing between 1 and 3 projects a year. Some of those projects will be of size or a criteria that don't fit what you do, or they might, like at the moment, they might be out of the market because they're struggling to sell schemes and they've got equity tied up in them, so they can't go and buy, or they just don't want to buy because they think that the land prices are too high and are waiting for them to fall and blah blah blah. So you can invest time, business development time, in those relationships, or you can invest the time in people who effectively are aggregating those people for you, right? And so there's a clear business logic in dealing with introducers and intermediaries in that context. So I completely see the merits of that.
I think the other thing, and we've been guilty of this, as I'm sure everyone has, is having a couple of clients you rely on too heavily.
Yeah.
You have a client you rely on heavily, something changes, they go bust, or they decide. I had, one that went bust last year. It was a fairly big client. And I've got one this year who's turned around to me this year and said, I'm just kind of a bit bored of this. Like, don't blame them. The market's been tough. I'm a bit bored of this. This will probably be the last project. Pack it in. And you don't get that with intermediaries because you've got that much wider network. And I also think you don't get that with a solid platform where you're generating direct leads like Ennis had, because you've got a constant flow of new people coming through. The other great one with the intermediaries is the fact that, and those introducers, you kind of get pre-qualified. You don't get, I would just like a chat, which, we do lots of and is a great thing to do, but you sort of get that as well, which I think is great.
You spend your 25 quid per Google AdWord or whatever it is, right? And and of course you can get a big flurry of inquiries, but how many of those are complete tire kicker time wasters, right? Kim's obviously in the room. She runs our marketing. There's no way in hell we'd spend money on Google AdWords for bridging those, because we'd burn through a lot of money doing and waste a lot of time trying to acquire those clients.
in the year 2000, probably it was a 60-40 split between intermediary business and lender. 60% was intermediaries, 40% was lender. I'd say now it's probably 90% broker, 10% lender. That's a booming market, in my opinion. 50% bigger than it was before. So it's up to us to take advantage of that opportunity. So whilst certain volumes might be down, I think the opportunity is greater now than it's ever been before.
And as you were saying, and I've seen you say it online, the number of brokers that are actually active in the mortgage market is 1/10 of what it was, 1/10 of that 250,000.
Yeah, strong. I mean, some of those brokers would have evolved into IFAs. That happens as part of that, and I did that myself. I just didn't enjoy that part of the job. So there are definitely less of us doing more work. Now, that's not to say that I don't think we could probably still get rid of the percentage of that workforce because, it's an aging industry. And I see an awful lot. The problem with our sector is it's very easy to get into. It's very low level entry to get into. Very difficult to get back out of. There's very little exit route for a broker unless you have your own firm and you can build that up to scale it and then potentially look to sell that, which is what happens in the IFA world. It's a very active market. In the broking fraternity, very rare.
Yeah, I mean, I guess, so what you're saying is that a lot of the individual one-man band brokers, are whether they're DA or whether they're part, or whether they're, part of a network, they essentially living hand to mouth, and it's very hard to replace that. It's very hard. Once you're in it, it's very hard to know where to go, what else to do to be able to make a living, essentially.
I'd like to think they're not living from hand to mouth after all this time. I'd like to think that they're actually doing quite well. I think the average broker does one mortgage a week, and that's a number I've heard and haven't seen anything to disprove that. So what that suggests,
residential mortgage, residential, or
I would think it's probably more. Well, I don't know, but I would think maybe that's more on the residential side.
Yeah.
The problem is that will generate enough money to give an okay lifestyle, which is then 4 days golf, 1 day mortgage. That seems to be the case if you look on LinkedIn. But that doesn't create wealth. That creates income. It doesn't create wealth. And wealth is what people will need to then be able to exit and sell and move on. So I do think, and this has always bugged me, and this is one of the rants I do go on a regular basis, is that we if the lending market is £300 billion, give or take, in an average year, £300 billion, and we control 90% of that through intermediation across 15 to 20,000 brokers, why aren't we creating value?
And I can't answer that. Because
no one can. I'm still waiting for the answer. And the reason is because it's a very fragmented, very disenfranchised, very isolated industry, which still actually comes out of that 1990 early philosophy where everyone was self-employed, one-man bands, and you killed what you ate. Oh, sorry, you ate what you killed. I'm talking about that. So you ate what you killed, and that's still very prevalent today. That people talk about, that's my client. There's this inherent feeling that they own what they do. Well, that's not really the case. The consumers are very transient individual and very fickle at the best of times. So because of that, because of the way we've been established, because of the culture within that industry, and also in many respects, we haven't evolved mortgage intermediation in any way, shape or form in 25 years, we end up with a business that's worth £300 billion, controlled by us and not many others. And yet, how many people can create wealth within that? It's not many, it's a handful.
It's an interesting one. I mean, when I obviously we're not involved in the residential sector or the regulated residential sector directly, and so, but we do speak to your counterparts who have divisions within that. It strikes me that particularly over the last 2 years, particularly let's say post Truss, kamikaze budget. the residential side of the business, those that had residential sides of the business, and there's plenty that we know who don't have residential sides of the business who may have struggled, but those who had residential sides of the business, they're able to keep the lights on with that residential business, but the sort of the bunts, the wealth, as you put it, tends to come from the commercial, from the specialist sides of those businesses. And one of the things that we get told is that there's a lot of work to do. There's a lot of work to do a residential mortgage, and there's ultimately the remuneration for it. Like I said, it keeps the lights on, but it's not especially profitable business to be doing. So, taking that into consideration, do you think that there is a pathway to disintermediation through technology? Do you think that is a glimpse at the future of the residential mortgage market?
I don't think technology is a major threat to good mortgage broking in any way, shape or form, because the internet was going to finish us off 20 years ago. That was going to be the end. Then Google were going to finish us off, and then Amazon were going to finish it. AI is going. We are the crocodile of the business world. We will be here in 4 billion years, whether people like it. I'll probably still be here myself. We will still be here, okay? Because it's a people industry. Yes, technology can do some heavy lifting, but it can't do a lot of the heavy thinking. And if you see some of the situations that you see at Avamore and other specialist brokers, and even on the residential side, there are no vanilla cases anymore. Okay, sometimes, and it's an emotive product. And until the algorithms can learn how to emote, I think people will always go to people to consult and to seek validation and to hear anecdotes and just get confirmation that what they're doing is the right thing.
Can I challenge you on that?
Sure.
I don't disagree with you. I don't disagree with you as of today, 2024. But and I've had this conversation with a number of your peers during this podcast series. I don't know whether you've got kids or anything like that, and what age they are. I've got a 13-year-old son. I've got 3 kids, but my oldest is 13, and so much of their existence, so much of their socializing, so much of everything that they do is online via computers. I'd like to think they're fortunate enough that they're actually engaging with people on a face-to-face basis more than maybe some of their peers do. But you see statistics where some teenagers are spending 15 or 16 hours. You get that Apple alert of how many hours of screen time. For me, it's like a bad day. For me, it's like 4 or 5 hours. Maybe the same for you. For them, it's 15 or 16 hours, and they're not engaging on a physical interaction basis with other people. In fact, a lot of it is just through, they could even just be spending their entire time talking to bots. So, my challenge to you is: do you think that theory stands up in 15, 20 years when my son is looking for a mortgage, for example?
It's a good challenge. We're both going to be guessing the answer to that. I've got a 16-year-old. They live on their screens without a shadow of a doubt. It's worrying. I'm more worried from a personal perspective than I am from a commercial perspective about how much time children spend in a digital world. And I think it will significantly disrupt their soft skills and how to interact with other human beings. But if they're all growing up the same way, they might not notice it. It'll be us as the dinosaurs looking back saying, wasn't like that when I was your age. So that will be their time at some point. How they will live within that time is anyone's guess. Anyone that can get ahead of that will make a lot of money in predicting that behaviour. But we also heard that the internet was going to kill us off and first-time buyers would do everything online. One of our biggest business sources is first-time buyers. They ring us. They want to have a Zoom call. They want to have a physical, verbal meeting or conversation with us to discuss it. Some of that will come from their parents. What do you do? What do I do with this, mum and dad? I would speak to so-and-so. I mean, again, just an indicator of age. I'm now doing the mortgages for my clients' children's. That cycle evolves on again. So, look, that might change in 15 or 20 years' time. What it will look like, I don't really know. But in order for technology to improve the whole system, I don't know if the investment would be worthwhile, because you have to invest that into conveyancing, evaluations, the land registry, and every individual lender alongside every individual estate agent and mortgage broker. That's a lot of money. And everyone's going to have to do it all at the same time. So who's going to take that mantle? Good luck to them. It's not going to be me. I know that. I struggle with the Etch-a-Sketch, let alone a computer. Look, if someone can do that, they'll make an absolute fortune. But it goes back to what I said a moment ago, Michael. It's a very fragmented industry. You've got Barclays will be doing one thing today. Halifax will be doing something else. Just, there's no co-joined thinking going on to improve the whole sector, to give us a roadmap for where we might be in 10 years' time.
I do find that clients, look, it's good for the broker if they keep her clients and they keep her, but sometimes you've got to ask the question, are they doing right by me? TCF, that's all I believe in. Treating customers fairly. I don't have swanky offices. I don't have high demands. So I don't necessarily need to get big fees, something sensible, something, proper recompense. But I've seen situations where people are paying more than the arrangement fee. And I'm going, why are you paying that? Because if you gave your client back some of that, you're still doing quite nicely and your client's better off. And you see that, that's the great thing. I've been an old lag, been around the block, got the grey hair. I get people tapping me up from time to time that have had a very good relationship with somebody. But I go, well, actually, just a minute, go over there. There's something better. Why haven't they taken you there? Because I'm not doing anything that's particularly unique. Yes, I know hundreds of lenders, but in reality, I don't use that many. It's more a case of, can I fit them in the box? Because you want reliability. Can they deliver? Will they deliver? Right now, when the sun shines, everybody can deliver money. But when it doesn't, what's on your book? What's distracting you? Are you lending? Can you lend? Is your pricing sensible? It's shifting sands, and that's what brokers do. They find they create a problem. Why am I a broker? When I was working for Frank Russell, I was earning a decent salary, 95, got my first flat with what is now my wife. I went into my local Halifax and said, this is me, this is my wife, this is what we do. And they said, yeah, there's a mortgage. I changed my jobs. They said, we can't do it. Well, guess what? My wife worked in an estate agency business. She went to a broker she knew, and he took us back to the same people. And the answer was yes. So I recognise what a broker can do, and it all comes back to doing the right job constantly. You've got to be persistent about it. I don't ever expect my clients to not look. They'll be tapped up by somebody else. You've got to be on your toes all the time, going, can you do this? Is there something better? And sometimes I'll take a deal to quite a lot of people, because one, it gives me a distinct, market share. And sometimes lenders change the goalposts in a positive way and negative. You think, oh, they probably won't do it, or they don't price it in a certain way, and then suddenly there's a great offering. And that allows me to go, I'm doing the right thing. I'm doing whole of market, new lender, new proposition. Oh, I forgot them. I've made a mistake before by not thinking a lender would do the deal, and someone else took it to that same lender and they did the deal. I'm thinking, well, that's a loss fee for me.
You've got to. You can only place a case with one lender at a time. So, and is there not a point where actually why am I sending this to 20 lenders or 8 lenders or however many you're sending out to? There's clearly a limit to the number of lenders you're going to want to send a deal to, right?
Well, you ban lenders. Banks tend to be slightly cheaper. They've got access to, but they're much more vanilla on what they want. You've got to fit in the box. It's not and they're harder work. The processes are generally slower. Absolutely. Then you've got the finance houses, and they come in the form of, I call them finance houses or family offices. To me, our business is property-based lending. It's money management. It's not stocks and shares. It's just property-based lending. End of. I love the way that things are sliced up: senior, stretch senior, super stretch senior, MES. This capital stack, and then you have the part finished things. it's just real estate lending. It's just how you price it that determines, it's a risk adjusted kind of thing. Sometimes I have to. I could take, and rather than taking it to one and then say no, I will package a deal up and send it, distribute it uniquely, not here you go, 30 lenders fight it, because there's no certainty that you'll do a deal because there's quirkiness.
You were talking about, fees, procuration fees, and brokers even taking more of a procuration fee than the arrangement fee. We had Martin Stewart come on the podcast. I interviewed him, I guess, a couple of months ago. We're only in the process of releasing that episode shortly. He was actually advocating for the banning of proc fees and effectively clients paying brokers directly. Now, from the lender's perspective, we'll pay whatever the going rate is in the market. But what do you make of that take? And do you think that that's something that you agree with, or you actually think that actually the current system works? It's just how it's being adopted.
It's topical at the moment because, of course, you've got the motor finance thing.
Can you actually speak to that a little bit? Because I don't know if everyone in our audience will be aware, particularly those outside the specialist finance space.
The car finance world has had what I think they call hidden fees, not disclosed, not transparent. Whether it's accidentally or on purpose is another matter. But there was some case law, and they are now having to wind back the situation. Apparently, it all falls onto the lender rather than the brokers, even though you kind of think, well, the real beneficiaries are the brokers.
Yeah.
We'll wait and see. And I know I've been a member of the NACFB. They've created a new template for, okay, it's not for me because I don't do car finance and never have done, and probably don't have any ambition to right now. For fuller disclosure, where you get the client to sign something before it actually happens. But you know what? To me, it just sounds quite similar to how it works in the regulated space. Everything's got to be documented. There's nothing hidden. There's nothing disclosed. I'm for full transparency, But what you've got to remember is, and this picks up on this Martin Stewart fellow, I'm not sure I know.
It's from London Money.
Okay. I wouldn't mind, but if a deal closes and you don't pay me because you haven't collated that element for me, how do I know my client's not going to pay me? Have I got time to chase them? I'm not trusting of anybody when it comes to money because, it's funny how it's stuck in the post. The chaps didn't work.
Yeah.
But an arrangement fee, or the fee that us introducers get, is a cost to the client. It's not a cost to you.
No. You
are just a facilitator of the movement of that money. And if it's there in black and white, whatever colour print you use, and it says it's going from here, from there, and part of the arrangement fee is disclosed, I don't know why you need to do it a different way. I know there are a small number of banks, particularly banks, that don't do that. You have to take the fee off your client. Fine. I've done it once or twice, I think NatWest and Lloyds before. But otherwise, most of it's part of the arrangement fee, end of.
Yeah, I totally understand why, from the broker's perspective, you don't want to be chasing a client for payment for a deal that's effectively paid out. Most developers, most developers, I often joke that many of them are degenerates at the best of times.
It's spent before it hits their bank account. It's gone.
Yeah, well, when we have developers who come to us for the first drawdown, and there's nothing on site, but they're claiming for 100 grand's worth of preliminaries and whatnot, and they're driving around in a new Range Rover.
Yeah, funny that.
Yeah.
It's like bounce back loans for 50 grand. That's just enough to get yourself a Range Rover Vogue SE on the money, 49950, and they sold out. And then people say, well, actually, you've got to pay back that money.
Yeah.
The car's a depreciating asset. Well, why did you do that? It's meant to sustain your business. But have I answered your question? We talked about fees, how they work, why I think they should stay as they are.
Well, I think it's as much of anything as a discussion point, frankly. So we don't need it. We don't need to come to a conclusion on anything.
No. And I'm sure there's two camps on how it should be done, but it's got to be at the benefit of the client.
Yeah,
that's it. As long as that's first and foremost. I mean, how many deals come across where it's broker first, client and lender equal second, or shall I say third?
we worked in the past with a broker, and I think the broker and the broker had a habit of bringing cash starved, relatively inexperienced developers to us, and they were structuring the senior, mezz if there was mezz, and equity, and because the clients weren't particularly experienced, sort of didn't really know what they're doing. The general outturn of the deal would be the broker would make loads of money, the lender would make less than the broker but be fine, would do all right, and then the client and the equity would lose most of their money, if not all of it, and the client would end up bankrupt. We certainly saw outcomes like that. As things progressed with some of the deals that these brokers were doing. So yeah, we've definitely seen it. There's definitely elements of that out there. It's just how it is. If we just rewind back in terms of the history, how did you go from working for Henry Moser to then Bridge Development as you are now?
I got sacked.
You got sacked. Okay.
Simple as that. Not performing enough.
And then was that it? Was that it straight to becoming a broker, or
got my train fare home on a Thursday, and by Monday I decided to set up with a broker, and I just rang up a few of my old clients. And bear in mind, I hadn't actually lent money for a little while. I said, look, but they remembered
because you've been working in the workout.
Yeah, I'd worked in the workout at Davin and the workout at Toyota, and I came across people that I dealt with, and I mustn't have insulted them because they gave me opportunities.
Because they were back on their feet, they were back developing,
some of them were quite substantial. There was never really a big problem. It was certain circumstances that were problematic. But I remember one, Pat, he said to me, Phil, you looked after me when things were tough. You didn't beat me up. I said, so have a go. And so I had a couple of all you need is a couple of active clients. You don't need lots. And that's sustained my business for a while until I started marketing and getting out and networking and all the rest of it. And I kind of enjoy it because it's quite peculiar to move from selling one set of products, whatever your employee had, to this basket. You got to hear about them, but actually see them in writing going, blimey hell. All right, at Davenham, 85% loan to GDV was exceptional. I get that. That's like stretch. That's almost like 100% of the capital stack, effectively. It's
equity light, isn't it? There's nothing light about it. In fact, it's full equity, isn't it?
But how much do you think it cost?
I actually don't know. Well, it must have been, I don't know, 15, 20%?
Actually, quite close. It started at 18 and went up to about 24.
How did the client make any money out of that? That's my question.
Well, when you put nothing in, and you've got another scheme on the go here, that's making you're taking all the profitability out of that one, and this one you're getting a bid. It could be enough.
Yeah, okay.
Be surprised, but things were selling. There was a lot more pre-sales, there's a lot more activity in the market.
I suppose it was a hot market. If the property price is going up 15-20% every year.
Well, do you not remember there was a period in time where you could do nothing and earn more money from your house uplift every year than your salary. And your salary.
Yeah.
So it was that sort of era, and everybody was bundling. Gazumping was common as much. So it was a different environment. Oh yeah, we were backing the right people. We weren't taking on novices. There were people who could do the job. So yeah, 18 to 24% doesn't look too bad now. No. It's kind of almost like mezz money now.
Yeah. But for the entire capital stack, not for the usual sort of things like that.
You can have it always, It was one of those where, as a salesperson, you had to put a lot in the hopper for some of it to come out. But you know what? You'd be surprised when people go, I've got to put nothing in. How good's that?
Yeah.
They almost forgot the math.
It's an option, isn't it? It's a free hit in a lot of ways for some people. So.
But when you're building a scheme and you build over a term, if you can sell something early, that starts to reduce your debt quantum. So suddenly the profitability starts to expand. And the circumstances then were very different to where they are now. Now people are, I've got a guy who's built a scheme. His first sale was 22, 3, 4 in 23, 8 this year. He's still got best part of 30 to sell. Poor situation. Otherwise I would have suspected back in that period of time we would have probably got shot of the whole lot within 15 months. End of.
Yeah, it's bad timing, isn't it?
But, when you borrow money, you've got to pay it back. Where does it say, you don't?
No. Well, you'd be surprised the number of people that borrow from us and, forget about that part of their obligation, you know what I mean?
When they got past the numbers, they don't look at the cost, the time, and yes, you've got to pay it back. And if you don't, they'll be not interested.
When we had Martin Stewart come on, he's a pretty strong advocate for, which is, should we say, against proc fees. He thinks that lenders, I imagine particularly in the residential space, lenders should pay brokers essentially an annual sort of subscription fee in a lot of cases to distribute their products rather than charging proc fees. Do you believe that the model that you have at the moment in the residential sector, the regulated residential sector, is the best one? And where do you see fault in, say, Martin's views on proc fees?
It's an interesting one. I think it's quite difficult to do an annual charge. I'm not sure how that would work with lenders. Well, if every lender pays you a certain amount to distribute their products, what happens when it's not the right product and a lender hasn't been competitive and you end up just selling one mortgage or no mortgages? So I think that the current proc fee way is actually probably one of the best and fairest way of doing it, because you're actually paying by product or per sale, if you like, which I think probably works the best. There are different ways of doing it. In a perfect world, as a business owner, it would be great to have actually not paid as a lump sum, but actually paid over a drip. Over the course of the mortgage, if it's a 5-year fixed. But that's quite hard to change the market suddenly overnight into that type of basis. But it's about actually lenders recognising the work that brokers do. Martin's a contrarian. I'm sure he
is.
He doesn't mind me saying that.
He won't know.
So I think that there's nothing essentially wrong with the model. It's just how, for example, it could be fairer, and it should be more equal in terms of whether you're a DA or an AR, the type of business that you give. It should be fairer. It should probably be a lot more the same amount payable up to a certain amount, and it shouldn't be heavily weighted in terms of networks or clubs or that kind of thing. I think we want a level playing field, and we also want a level playing field whether it's a purchase, a remortgage, or a product transfer, because the amount of work that a broker does is the same in all instances. The admin work might be different. The work a broker does, which is essentially what the proc fee is for, is the same. And then also I'd probably have it capped as well across the board. So I don't really think that anyone should get more than 1% on a procuration fee, whatever the product is, whether that's later life, whether it's commercial, whether it's mainstream.
Well, certainly in the bridging space or the non-regulated bridging space, there's certainly some very large proc fees can be paid. Even with an arrangement fee of 2%, you'll sometimes get brokers being paid 2.5%. So the lender's not is effectively in loss-making territory when the loan's drawn, and only starts to recover when you're a few months in.
I don't quite understand why that's happened.
Yeah, I mean, I guess it's just the competitive nature of that space, isn't it? But these things are constantly evolving and changing, so I guess we'll keep monitoring the space. You recently were acquired by One Dome. There's been a spate of M&A transactions over the past 18, 24 months in the specialist finance arena. Do you think that's a trend that's going to continue? And what do you think are going to be the drivers of the mergers and acquisitions that keep taking place?
100% it's going to continue. From a broker's perspective, because it's so bloody hard to make money. And it's as a mortgage broker, it's quite a low margin business. And if you look at how brokers have been in the firing line since sort of that Brexit position and all the different things have happened, and the last 2 years after COVID, the last 2 and 3 years have been relentless. Brokers are seeing more regulation. They're doing more work. They're having to rebroke cases 3, 4, 5, 6, 7 times. There's a more litigious atmosphere generally. Procuration fees haven't increased ever. So whereas you've seen lender fees increase over the years, proc fees are still basically pretty much the same as they were when proc fees started, a little bit higher, but not that much. PT proc fees are still woefully inadequate for the work that a broker does. And brokers are tired. They've worked really, really hard. And the late nights and the early mornings and the weekend calls is getting a bit much, and it's really hard. And that's my big fear for the industry. If we don't look after each other, actually the number of advisors, as we've already seen, is starting to fall. If you're a new person coming into the industry, why do you want to get into the industry? It's hard work. It takes a while to get a client bank. It's not as easy as it used to be. The income that some people perceive that they can, earn 100 grand within about 5 minutes, that's not reality. So it's quite an interesting environment at the moment. So I think you will see a lot more mergers, acquisitions going on, partly for that reason, and partly because there is strength in size and strength in numbers. So I think whether you're a smaller lender finding it hard to compete, especially when pricing is all over the place, if swap rates are up and down, if you get your funding in a different way, then it can be really hard to compete. So I think there's going to be more and more rationalisation, and certainly, I think there's quite a few who I think are in talks at the moment with various things, but whether that comes to anything or not. But I think definitely there'll be more of that in 2025. I think it'll be a really big year for that.
Well, I think that makes a lot of sense, and certainly there's plenty of scope for consolidation, a lot of opportunities for vertical integration. And I remember you talking to Gary Dass about about insurance, for example, the having an insurance brokerage acquiring a mortgage brokerage makes so much sense, because you've got that sort of recurring revenue from the insurance, absolutely. But it's almost like the mortgage business is this incredibly effective lead generation funnel, and then once someone kind of gets into the insurance space, they then become that nice annual recurring revenue stream, because I guess people are you need to renew your insurance every year. You might only be doing your mortgage every 5 years, or even longer than that. So and
the good thing is that brokers are getting better at looking after their retention clients and starting to prove for the first time that actually that mortgage business is retainable. And tech has definitely helped with that, and will get even better. So now you're seeing mortgage firms with retention rates between 40 and sort of 80%. And when you're getting to the 60s, 70s, 80%, you're going to retain your clients every 2, 3, or 5 years. Then that's something else that we've never really had before.
Well, that was a debate that I had with Martin Stewart when he was on the podcast, which is his view was that mortgage brokerages didn't have value, and my argument was in line with what you were saying, which is that, well, if a client's has to renew a mortgage every in 40 to 80% retention rates, to my mind, mortgage brokerages are strategically undervalued relative to what the market is willing to pay for them. So I think what you just said kind of emphasizes that, and certainly people who are, in the lending, I can see merits in a lender buying a broker, but actually, someone within a vertically integrated space like a wealth manager or like an insurance brokerage, for them, or even accountancy businesses, it makes a lot of sense in my mind.
Yeah, I get what he's saying. If you're a smaller company, if you're a 2-person operation or 3-person operation where the client base is mainly yours, and what happens when you step away? Where is that value to the clients, etc.? It's something we've tried hard to do. If you've got a certain number of people, if you've got a good brand, if you've got those ways of retaining people, if you're starting to prove that you're protecting them properly, you've got that recurrent income with general insurance as well, then actually there's value there. Because is Corico going to exist if I step away from the business? Of course it will. They're brilliant people. They're going to carry on. People have bought into the brand. They haven't necessarily bought into me. As much as your ego would like to suggest it's all, no, if I leave, it's all going to go downhill. That's absolute nonsense. Corico is a living, breathing entity in itself. So there's value there. So if I'm not there, we'll still be fine. And that's where you want to get a business to. You want to get it to a position where if the main people weren't there, would it still carry on? Would it still continue? Would it still retain clients? And if you get a business to that level, then there's value in it. And I agree. I think mortgage brokerages are undervalued, because actually when you get yourself into that position, then why can't it be looked at the same way as if you're as a wealth manager?
Thank you for watching and listening to the Property Funder podcast. You can find me on the internet at property_funder, and please remember to like and subscribe. See you on the next one. Thanks, and bye-bye.